Why don't we get started? Hello, everyone. I'm John Mommaerts, but I think most of you know me. I'm along here with Jason Rowling and Haley Wynio in our office. We have a special treat for everyone today with our special guest, Ryan Detrick. Many of you are watching this live, but we also know many others will be watching the recording in the next day or so since they are working, picking up kids, or whatever. But so welcome. Just wanted to touch on our agenda today. We're going to have a presentation by Ryan for about 40 to 50 minutes or so on our end of year outlook for 2025 and a little peek into 2026. I think you'll find this very informative and entertaining. Ryan has a good sense of humor, and it probably has something to do with his Cincinnati Bengal fanship. Maybe it's something else. He'll, he will make this very entertaining for us. We'll leave a few minutes for Q&A at the end. We have some questions that were provided, but feel free to send more to the chat, and we'll try to get to as many as we can. So with that, allow me to formally introduce Ryan Detrick. Our Marquette office has been working with Ryan and his team pretty extensively since we partnered with Carson in April. And I've continued to be impressed by the quality of the research that he and Sonu put out for us and his whole team. They've really been very thorough and efficient with their information and analysis, which has really allowed us to spend a lot more time with all of you rather than doing research. So a little bit more about Ryan. Ryan is the Chief Market Strategist at Carson Group. Ryan brings a wealth of expertise and a strong understanding of financial markets to guide our firm's strategic investment decisions. He has the ability to distill complex market information into actionable insights, which has earned him recognition as a thought leader in the financial industry, including being named one of Business Insider's 2023 Oracles of Wall Street. And I actually had to look up exactly what being an Oracle of Wall Street was. And what it is it's an award, not a single annual award, but a title often given to prominent financial analysts known for having a strong track record of making accurate predictions, and particularly if they went against consensus. And there's some very big names on the list. So Ryan, you're in good company. Ryan is a sought-after commentator, wears market perspectives through regular media appearances on CNBC, Fox Business, Yahoo Finance, Bloomberg, Sirius, XM, speaking engagements, and written commentary. He leverages his extensive knowledge of market trends, economic indicators, and investment opportunities. Ryan provides valuable insights that empower our clients to make informed decisions in an ever-evolving financial environment. Ryan also co-hosts a top investing podcast called Facts and Feelings alongside Carson Group's colleague Sonu Varghese, which we've been sending many of those to you. So I think many of you have some experience seeing his podcasts. Each week, they engage in insightful conversations exploring the intersection of data-driven market analysis and the human element in investment decision-making. Through facts versus feelings, Ryan reaffirms his dedication to making finance more understandable. He has a chartered market technician designation, a bachelor's degree in finance from Xavier University, and an MBA from Miami University. So with that, it is our pleasure to welcome Ryan today. So welcome, Ryan, and I will pass control over to you.
Awesome. Well, thank you, John, and thanks to everybody. So I heard April. Boy, it's been a good run since April. What a time to start with that near bear market we had back in April, though, and everything that's gone on. But I'm excited to be here. That was a great. I just need to have you introduce me every time. That was thorough. I did do that. I did do that. That's right. Yeah, yeah, yeah. Actually, we work with a PR firm, and they sent out a thing just about an hour ago with some of the calls we've made this year, and they're putting me up for that Oracle of Wall Street again in 2025. Maybe we can get it again. We'll see. But I'm excited to be
Good.
here. I'm a Xavier boy. I know Marquette Xavier, so we'll see. Although Xavier, we're not very good this year. We lost our coach. We lost our whole team. But anyway, and the Bengals, yes, Bengals are terrible. But I said that's why God gave me Ohio State. Ohio State football is loaded again. We're looking good. We'll see. I want to cross our fingers, but we'll see how that goes.
And you
But
remember you're in Michigan. Half these people are in Michigan, Ryan.
yeah, that's not good. I just upset everybody. Well, I mean, we might lose that game, but we can win the rest of them. That's kind of how we that's kind of how we look at it
Yeah, it's
anymore.
all
I don't
good.
know.
It's all
Yeah.
good.
So again, excited to be here, everyone. And there's me. There's me. Been with Carson for about 3.5 years now, market strategist. My role is kind of what we're doing right now. I get to communicate what our 16-person research team does. I think what makes us neat, or even like you see me out there, our team manages almost $7 billion, right? So if you see me on CNBC, I'm on CNBC all the time. I'm all over the place. For whatever reason, they keep inviting me back. I have a face for radio. What can I say? But they keep inviting me back. But we've had some really good calls. I think we do a good job explaining what's really happening out there. Nobody's always right. Nobody's always wrong, but we're always going to be honest, upfront, and actionable when we talk. And that's what we're going to do for the next 45 minutes, 50 minutes or so. Then plenty of time for Q&A as long as you want. But the truth is, we manage money. A lot of people you see on TV don't. I'm just to be very blunt about that. So when I'm talking today, and I kind of playfully did the old like a little, little view on 2026. No, we don't have our official 2026 outlook like officially done. We're still pretty optimistic, and I'll kind of hint and give away some of the clues of what we're going to share with the world here in a couple months. But we still think things are pretty good out there. So let's see what else we have. Okay, so by now you're like, okay, this guy clearly does have a face for radio. Who is this? If you go to carsongroup.com and somewhere up top, you click on like who we are and you click on, executives or whatever. I actually rank everyone on the same line as the company dog. So that's where I rank. That's Nellie. Unfortunately, she passed away not too long ago. That's Ron Omani Carson's dog, our founder and chairman. Anyway, it's a little playful thing. I'm on the same line as company dog. So one more little fun one, then we'll get into it. This is my friend Robert. He, I think in 2018, 2019, made some real important changes in his life. He looked in a mirror and he wanted to do changes. And you think about it, we're almost at the end of the year. I mean, that's what we're talking about. It's November. We start making goals, right? Goals for 2026. What do we want to do? What do we want to change? How do we want to get better? Cut out some of the things we don't do that, hold us back. And Robert, I was really proud of him because he looked in the mirror and he really, really made a bunch of changes. In 2 weeks, he lost his glasses. I was so proud of him. Anyway, so yeah, never mind. Don't be like Robert. That's a little joke there. But I like the saying, plans are useless, but planning is everything, right? President Eisenhower said that many, many years ago. I think that's what's so neat about what we're doing today, right? We're planning. We're thinking about what's happening in the economy. I assume I can use the F word. I think we have all adults on here. I'm going to use the F word. The Fed, that's my F word joke. The Fed, we're going to talk about the Fed and interest rates and earnings and inflation and all the crazy stuff you see on TV. And honestly, I kind of like doing this now because a week ago right now, the Dow Jones Industrial Average is hitting its all-time high. It started trading May 26th, 1896. Stocks were like never higher in history this time 5 days ago. All right. Now, honestly, the last 5 days haven't been all that great. We'll talk about it. I'm not super overly concerned. There's some stuff going on. I will say this. NVIDIA had earnings like now or sometime, so I'm anxious to hear NVIDIA. You probably know NVIDIA, huge company, largest company in the world, $4 trillion, or maybe not anymore. They might have come back down, but they have earnings like right now. So anxious to see what happened there. But the reality is there's so many things going on out there, and we're going to talk about some concepts. Yes, what's going on out there, but I love to point out the big picture things, the things we always need to remember. And again, as we head into a new year, just those things to kind of dust off and think about how we should look at our investments, right? But again, plans are useless. Planning is everything. I'm just excited to be here with everyone today. And again, we're thinking about plans, where we're going. So put it in perspective. You think about this year. Stocks are up ballpark 15% on the year. Probably know that, right? Well, maybe not, but they're having a good year. Bonds are having a good year. Gold's up a lot all around the globe. Most stock markets are up pretty good this year, but a good year. I mean, you're probably worth more money than you were 12 months ago. That's the best way to put it, maybe by a decent amount in some places. But it's never easy, right? On the top, you think, here's your plan. Okay, I'll hold stocks for the next 30 years. I'll make, I don't know, 8 to 10% a year. Yeah, probably can do that. But then reality, right? Reality is when you have a so when I say bear market, just know that means stocks are down 20%, means you're not happy. We're not happy. You're not happy. Nobody's really happy. Economy's probably struggling also. Back in April, when we had Liberation Day, if you remember that, President Trump held up that piece of paper that, said whatever it said about tariffs and freaked everybody out. We had a 10% drop in 2 days, one of the largest 2-day drops in the history of the stock market. And the bear market happened. I mean, a near bear market. We were down like 19%, close enough for government work. It wasn't fun. It was not fun at all. But now here we are, the other side of it. Back in 2023, March of 2023, something called the regional bank crisis. You might kind of remember that one. The 16th largest bank just boom, poof, puff, disappeared. Some other banks were wobbly. We were really worried back in March of 23 because remember, we had a bear market in 22. Stocks down a lot in 22. Started the rally up to March, and then all of a sudden, everybody's worried the next shoe to drop is regional banks. Unfortunately, wasn't that big a deal. We got through it, and stocks did great in 23. 24 last year, August of 24 had something called the yen carry trade unwind. I hope no one even remembers what I'm talking about. But for about a week in August of 24, the market was volatile. The market sold off. We went to sleep the first Sunday in August, whatever day that was, I don't know. But the first Sunday in August of 24, knowing the Japanese stock market was down 14%. Knowing the U.S. stock market was down about 4%, you look at something called futures. We knew the market was getting crushed. We knew Europe was down 5% across the board. That, I don't care what you do this for a living. When you see something like that, that's uncomfortable for us. It's uncomfortable for you. But then you look up and stocks gained over 20% last year. We took it in stride. So like every year is going to have some of these scary things. So that's the reality, is every year is going to be scary. Every year is going to have bad headlines, which is a perfect chart where we're going. Call this my chart of worries, chart of fears. Since 1900, the Dow, you can see it there. It tends to go higher over time, yes. And look at some of those just honestly terrible things that have happened in our country's history or in the globe. Some of them flat out caused bear markets. They caused major peaks, had recessions after some of those. We got through them all, right? A couple of years ago, if we would have been able to do this, I would have shared a similar chart, maybe the same chart, and said, every time since 1896, the Dow might go lower for years at a time, right? But it's always come back to new highs. And I think that's really important to remember. There's an old saying, the stock market's the only place things go on sale, but everybody runs out of the store screaming. And we're seeing that now. I can't really talk individual equities. Well, I talked about NVIDIA, but I didn't recommend it. I just point out facts. But there's some large tech names that are out there that have pulled back a lot. Like a lot the last 2 to 3 weeks, as everybody's worried about AI. We'll kind of talk about that as we go through this. But those are some companies that people loved 3 weeks ago. And now they're all scared to death to touch them. I don't know. We've done this long enough. I mean, definitely talk to John, talk to the team before you do anything. But there's some pretty good companies that are a lot cheaper than they were 3 weeks ago. All right. If you loved them 3 weeks ago, now they're cheaper. I mean, maybe nibble or consider it at the very least. Is kind of how we look at these big picture things. And you can see here again, stocks, they're volatile, yes, but we like to say on our team, volatility is the price we pay to invest. It's going to be volatile, and that's important to remember. So coming into a little more about us for a second here. 3 years ago, right now, the stock market bottomed. Remember 2022, right? Interest rates were soaring. The Fed was hiking, massive inflation, terrible war going on, lots of bad things happening. Your stocks were down. Your bonds had a terrible year. Gold was flat. I mean, 22, it is what it is. You didn't make much money in 22. That's just the reality. Sometimes you have a bad year. That's life, and investing is similar. But in late 22, Sonu, myself, our team came out and said, hey, you know what? We think this is probably near a major low. We think the stock market's going to start going higher. In the second line of our January 2023 outlook, we said, if with some good news, stocks could hit an all-time high this year. That was I would have taken like over a 20% rally. I had media people reaching out to me saying, is this like an April Fool's joke? Like you can't be serious. It was hated. I took so many bows and arrows and body shots being out there, being optimistic that the worst that they kept promising us was over. Yes, 22 wasn't fun at all, right? 25% bear market into October 22. But we've been pretty optimistic. I mentioned Oracle of Wall Street 2023. I mean, I got that because there weren't that many of us saying things are going to be pretty good in 23. 24, we're pretty optimistic. 25, pretty optimistic. We're still in that camp. Now there's things that have changed a little bit, and we'll talk about some of those things. But coming into this year, we thought the stock market gained between 12 to 15%. That's right where it is. That's right where we are right now. I hope I'm wrong. I hope we get a little more upside, and I think we will. But that's what we came into the year. And bonds between 4 and 7%. Bonds are up like 6%. Bonds are having their best year, everyone, since 2000. I'm not saying 6% spectacular, but you know what? That's not too bad given kind of bonds have struggled, the last couple of years as interest rates have gone higher. The Fed is cutting. We'll talk more about the Fed. So bonds make a lot of sense in portfolios. I would say bonds kind of help you sleep at night over the long run. Stocks usually do better than bonds over 10, 15, 20, 30 years, but usually by a wide margin because they're riskier. riskier, so you're rewarded for holding something risky. But, in 2008, stock market down 40%, bonds were up 15. I'm not saying that made up for it, but I am saying that helped you maybe when you looked at your whole portfolio and said, okay, well, this part's down, but this part's up. I can go to sleep at night and I don't want to sell all of this part, which is usually at the worst possible time. It's how our brains work. So we've had a pretty good run. I will also say in April, when the market was down a lot and everybody's freaking out, everybody told us there's a recession coming because of tariffs. There's a bear market coming because of tariffs. All this really, really scary stuff was going on back in April. We pushed back against that. We never cut our target. When the S&P was down 15% for the year and our target was way up there at 15%, I'll admit that was a long way away. I'm like, oh, geez, this is, I think it's going to happen, but oh boy, that's going to take a lot of good news. Well, we've had it. We've had a lot of good news, and now stocks are there. And I know it's been volatile the last week or so, even more so with large cap technology. We'll get into some of that stuff. I think it was simply time, little air out. I do not think AI is in a bubble. We'll be very, very clear there. We can get more into that in Q&A if you want. But I think some of those stocks got ahead of themselves and they're coming back down. That's just how this works. There's still a lot of solid fundamentals, and I'm anxious again to see what NVIDIA is saying literally the time we're doing this, and I think they're probably giving some good news and justifying a lot of this. So why did God create economists? It's an age-old question. Why did God create economists? To make weathermen look good. That's why. Because there's a lot of economists that have been dead wrong for years. I mean, it is what it is. I know because a lot of them were making fun of us when we were optimistic, telling us how wrong we were going to be. Fortunately, we pushed back against that. So let's talk about that economy. This is something that's Sonu. I work with Sonu Varghese on our team. He's our, I guess it's his title. Supposed to give titles. VP, comma, it's a joke. It has comma in the title. We have to say that. Global macro strategist. Sonu puts together what's called a leading economic index. We call LEI. So it looks at 32 different components of different, honestly, I don't even know what's in there. I mean, this is Sonu's thing. Like it's real proprietary. I mean, I could find it, but this is Sonu's thing. This is telling us the U.S. economy right now, looking at leading economic indicators. Again, Sonu looks at a bunch of them here. It's what we call a diffusion index right in front of you on your screen there. It's getting better. The U.S. economy is actually getting better. Just today, there's something called the Atlanta GDP Now forecast. Atlanta Fed GDP Now forecast. Long-winded way of saying it's the Atlanta Fed looks at a bunch of inputs and they determine how the economy's doing. They're saying the third quarter right now, the economy right now is going to grow at 4.2%. I'll just keep this real simple. That's really, really good growth. We grew like a 2% the first half of this year, and almost half of that came from AI spending on CapEx. Not the end of the world. Usually the consumer is strong. We're going to talk about the consumer. There's clear weaknesses with the consumer, but not overall. Foundation still solid on our economy. And we just wrapped up earnings like today. NVIDIA is the last one, or maybe Walmart. Walmart, I think, reports tomorrow. They're kind of the last one. We had a spectacular earnings season. Yes, the government was shut down. Yes, we didn't get a lot of data because the government was shut down, but I like to follow what corporate America is saying. Those big banks, you know what they said when they reported a month ago? They said, we're making a lot of profits. They said, we don't have a lot of people not paying back their loans. Businesses are coming to us wanting loans. We're giving loans. A lot of strong things, and earnings were really, really solid from those big banks. You can always pick and choose a company or two that had bad news. Meta, again, if I mention names, these aren't recommendations, just factual. Meta, Facebook, it had some bad news. Their stock was down, okay. But there's overall, the majority of earnings season was really solid. This economy is in better shape, and our LEI, which never, by the way, never did this say there'd be a recession. In 22, 23, 24, everybody's been saying recession, recession, recession. This is pushed back against that consistently. Here's around the globe. Don't need to spend too much time on it. We're seeing some growth accelerations around the globe. Our base case for 2026, there is no recession on the horizon. When you don't have a recession, take a guess what happens. Earnings to be solid. Stock market tends to be solid. I've got a good chart of that coming up. We'll just leave that there. So 50 years ago this summer, Jaws came out, kicked off the summer blockbuster. All right, I think I'm sure some people in the room remember that. A little before my time, but I do remember the movie. The Donna. A lot of kids scared to swim. Hear that song, you're a little scared of water. But should we be scared of sharks? That's my question. You think about it. Yeah, I mean, sharks are scary. They're faster than us. They're bigger than us. They got those teeth, those beady eyes. I mean, you get bit by a shark, you're in some trouble. But the reality, everyone, is people really don't die from sharks. And if you know someone that did, I apologize. That's terrible. But like only, what's the number? 8 people? Someone remind me there. 10? Is that 10? Yeah. Only like 10 people die from sharks a year. I'm not minimizing it. I'm just saying that's not that many. And then you look like, I mean, 25,000 people die from dogs. My dog is literally barking upstairs right now. I hope you don't hear her. I hope my wife's telling me to be quiet. 25,000 people die from dogs. What's the one I like? Where is it here? The Asian assassin bug. I don't know. That sounds, or just assassin bug. Sorry. The assassin bug. I mean, that sounds pretty scary, and humans, I mean, humans tragically kill a lot of humans every year. But check that out. Check it out. Mosquitoes. Mosquitoes kill more than anybody. Anything out there. It's mosquitoes. Now we don't have to worry about that. That's malaria. Fortunately, if you listen to this, we don't not worried about that one. But I think it's where I'm going with this is with the media. I love working with the media. It's helped make my career. I'll be on CNBC. If you want to get up early, I don't think you should. I'm on CNBC like 5 in the morning Eastern time on Friday. I was in New York City last week on CNBC. You get to do a lot of stuff with the media. I think I'm on something tomorrow. I don't know. Whatever. It doesn't matter. Anyway, I'm around. So I've leveraged media to get our brand out there, to get the Carson name out there, to get our team's views out there. And we've had some really good calls for several years. And people keep coming back asking for that. But here's a little thing about the media. Their job, everyone, I hope I'm not bursting the bubble, is not to give you correct information. I'm sorry to say that. I work with them. I know this. In early 2023, their jobs get your eyeballs. Their jobs get a reaction. Their jobs get you to click on something. Their jobs get you to watch it, right? We all know this, but here's a little inside baseball. In early 2023, when the market was rallying like crazy, we were bullish. I've already laid that out there. I used to go on a show called Closing Bell on CNBC with Scott Wapner. If you watch CNBC ever, you probably heard it, and it's on all the time. I'm a friend of Judge. He's a friend of mine. Anyway, I call him Judge Wapner. For like 3 or 4 months, I wasn't on his show. I thought it was kind of weird because we were bullish. We were being right. A lot of people were wrong. Market going up. I reached out to the producer, said, "Hey, it's been a minute. Does Scott want me to come on the show?" And this is email. She's like, "Hey, well, are you guys still bullish?" I'm like, put my chest out a little bit. Oh, yeah. Yeah, we've been bullish for about 6 months now, and market's doing really well. Yeah, we're still bullish. This is literally what the CNBC producer wrote back. That's really nice, but you know what? We're not really looking for any bulls right now because, Scott's not really crazy about having bulls on the show because they don't get ratings. That's literally what the CNBC producer told me. Now, I went back to our team. I said, listen, everybody, this bull market is going a lot further. There's a lot more higher prices coming because I'm a contrarian by nature. So that's just kind of what it is. And hopefully that's kind of obvious, but I get to see this. So again, they make us worry about a lot of things, they being the media. They make us worry. Look at all this debt out there. Look at all this debt out there. $1 trillion of credit card debt, $3 trillion here. I mean, I'm not minimizing $18 trillion worth of debt all total in our country. But I call this denominator blindness. All right. That's the denominator. Look at the numerator. The honest truth, if you're on this call, you're probably in pretty good shape. Have you owned stocks the last 10, 15, 20, 30 years? You owned a house, couple of houses the last 10, 15, 20, 30 years? Your net wealth is probably doing pretty darn well. And yes, you might have more debt overall, but it's because you have way more equity. And I know where this is going because the question comes up, what about the bottom 50%? About the bottom 10%? Something called a K-shaped economy. Think about a K. Part goes up, part goes down. We're hearing this a lot lately, although it comes up every year. The part of the K that goes up, doing pretty darn good. There's a lot of people on the part of the K that's going down that are struggling. I do not have the answer to how to fix the K-shaped economy. As a steward of assets, right? We're fiduciary, meaning we have to do the best thing for our clients. My job, Sonu's job, our job on our team is to look at the aggregate, the whole thing. And the honest truth, from an investments point of view, from an economic point of view, the economy is in really good shape because, yes, the top 20, 30% is in good shape. On the left, it's something Sonu put together. If you think like, what are you worth? Well, assets minus liabilities. That's your net worth, right? So you do that. The household balance sheets are like in the best shape they've been in 25, 26 years. S&P 500 companies balance sheets are in really good shape. There was a lot of debt, a lot of issues back before the great financial crisis, different things. Companies are really lean, even after COVID. I mean, companies got really lean after COVID. Now, some hired a lot of people, maybe too many in a tech name. They're cutting some of the fat, trimming some of the fat. But the truth, again, balance sheets in corporate America and in households are in good shape, and those things matter. So when TV goes about debt, I get it. I grew up, in Ohio. I know you all hate me now, but I did grow up in Ohio. You know, my dad had an auto parts store, had like 60 employees. I don't think he had a credit card. He paid cash for everything. He'd walk around with money. I was like, Dad, don't put that money away. Like, big stash of money. Not very smart. But I grew up not using debt. Like it was ingrained in me. And I know every time I present, I know a lot of you feel this way when you hear about all the debt our country has. I don't have the answer to it. I'm just saying we have a lot of equity also, then that part doesn't always make the TV when they're talking about it. Okay, I guess we already had that in there, so we'll skip that one. So we'll talk a little policy, Well, so Will Rogers said, I don't make jokes. I watch the government and report the facts. He probably said that 75 years ago, and it's just as true now as it ever was. So we just had a government shutdown. I'm not going to get in the weeds of all the government shutdown stuff, but I will say this much. It was the longest government shutdown in history, but the stock market actually went up 2% during the 30, or was it 43, 43, 43, 43, I guess we don't have the official. It's 43-day shutdown. We just had a 43-day shutdown, and, you know, stock market went up. Well, that's normal. As we're sharing here, 22 previous times you had a shutdown, stock market goes up. Now, not all of them are as long as this one or as contentious as this one. We get it. But look what happens a year after those 22 shutdowns reopen. S&P 500's higher a year later, 19 out of 22 times with what is the number there? Almost a 13% return a year later. Now, just to put some context around this, your average year gains like 9%. Okay, so pretty good, 9-10%, pretty good. So you actually have a better than average return a year after the government opens up. It's never that simple, I understand, but there's just some things to think about. Now, a little more on policy. This guy's name's Jerome Powell. You've probably heard of him. He's in charge of the Fed, the central bank. Probably, you could argue, the second most powerful man in the United States, or arguably in the world, behind the president, because of what all Powell can do. It's a tough call right now. So the Fed has two, what we call dual mandates. It means he's supposed to do two things: keep prices under control and keep the labor market full, right? Those are the two. Now that's easy. That's hard. You push on one, you know what happens. The other one goes this way and vice versa. He's in a tough situation. What we're seeing now, we haven't had a lot of economic data for a while. Why? Because the government was shut down. So we didn't get economic data. So what they say is the Fed's flying blind or driving in a foggy car. All that stuff makes sense because we don't know how the labor market's doing. We're under the assumption the labor market is weakening right now. We've seen some pretty high profile layoffs, different things. We don't think the labor market's falling apart. We'll be very clear there. But there are some signs the labor market's weakening. So do we really need interest rates way up around over 4%? We'd say no. We don't think so. But the flip side to this, the Fed is worried if they cut rates right now, and there's a lot of stimulus coming next year, the one big beautiful bill, there's some tax stuff coming next year, there's some stuff to get the economy going. If they cut too much and then inflation comes soaring back, what did we really learn the last couple of years? People hate inflation. People hate paying more for stuff more than just about anything out there. I think honestly, people could take a bear market more than they could take inflation because stocks are the stocks, whatever. But you go to the grocery store and the stuff you used to pay costs a lot more than it used to. That's not it doesn't make you feel good. There's something called consumer confidence survey. It's a survey. Take it with a grain. Oh, actually, Michigan consumer confidence. The Michigan consumer confidence came out 2 weeks ago. The second lowest ever, implying consumers are more worried right now than they were in the middle of a 100-year pandemic or at the great financial crisis when everybody around, if you're in this world of finance, everyone you knew was getting fired or losing their job. A lot of people lost jobs during the GFC in 2008, 2009, obviously. So I'm not sure I totally buy that, because then you look at hard data and what companies are saying. People are still spending money. They're still going on trips. They're still going places. I travel all over. The steakhouse is always crowded on Tuesday night. All the planes are full. So I'm not minimizing how people feel, but I think a lot of that has to do still with when you go to the grocery store, you remember what you used to pay for bananas. Now you pay this or pay that. That's just kind of the world we're in right now. So Powell is in a tough place, because if he cuts too much right now and inflation comes soaring back, that's not good. Now, the truth, Powell's done in May. We know that. He's done in May. His term is up in May. President Trump gets to pick who's in charge of the Fed. President Trump wants interest rate cuts. He's not too shy about that. Now, there's some other people that think it makes sense to cut. A lot of people in the Fed just the last week or so have come back saying, you know what? By the way, so the Fed hiked a whole bunch in 2022, didn't do much. They cut, we call it 100 basis points. That's 1%. They cut interest rates 1% last year, and they've done 2 cuts so far this year. Their next meeting, or maybe not next meeting, but yeah, next meeting. Next meeting's in December. So will they or won't they? It's about a 50-50 chance of a cut this December. And again, the Fed is saying, well, we're kind of flying blind, a lot of fog out there. We don't have economic data. What Sonu's been saying, I agree with this. There's a new Fed chairperson coming in May. All right. The president gets to pick them. Now Congress has to vote and this and that and approve them. But for the most part, you don't know, but you're pretty certain the next Fed chairperson is going to be what we call a dove. A dove means more kind of lower interest rates, cut interest rates, kind of easy policy. A hawk means keep rates high and kind of slow things down a little bit. Probably going to be dovish, right? There's something called Fed funds futures. Without getting too geeky on this, it's the market's bet of what's going to happen. They're still looking for 3 or 4 cuts next year. So maybe the Fed doesn't cut in December. When you get the new person in charge in May, we think more cuts are coming. Our base case all year has been inflation is not that big of a problem. I know when you hear that, it's like, whoa, what are you talking about? Because honestly, we look at geeky stuff. We look at year over year numbers. Right? Year over year numbers, prices aren't up that much from a year ago. They just aren't. Are prices up a lot from 5 years ago when you remember what they were? Absolutely. But the market looks at year over year. There's something called shelter, like rents and shelter, your house. That's a huge part of inflation. That's starting to come back a lot. We have real-time data from Zillow, apartment lists are saying rent prices are coming down, used car prices are coming down. Not everything, I get it. Some stuff's going up. I mean, this is the yin and the yang of the market. But inflation really isn't quite a problem in our view. We think the labor market, the weakening in the labor market's a bigger issue. So we think the Fed should be cutting going forward. Maybe they don't in December, but next year more cuts are coming. And one more thing on this. One more thing. When the Fed cuts near an all-time high like they just did last month on, I guess it was October 29th. October 29th, the Fed cut at an all-time high on the S&P 500. 21 times the Fed's cut near an all-time high. 1 year later, the market's been ready or higher. Take a wild guess. 21 times. An old saying, don't fight the Fed. If you have a hawkish Fed like in 2022, that can be trouble. Now, I'm not saying it's a bad thing. They got to slow stuff down. There's a reason the Fed becomes hawkish and dovish. But we have a dovish Fed next year. That to us suggests, yeah, this bull market is still alive and well. I don't know if you guys ever eat Colonel Sanders, Kentucky Fried Chicken growing up in Ohio, southwestern Ohio, like I did. We had that a lot. There's the Colonel there. Now, things aren't always what they seem. I want you to look at that bucket, the bucket of chicken he's holding. And look at the Colonel down there wearing that funny little tie. But then you look a little closer, and my question to you is that the Colonel just with a really small little body? Hopefully that makes sense. Yeah, a little joke there. So it's all in the eye of the beholder. Now you see that picture of the Colonel. It's just the Colonel with a little small body. That's what you're going to see the rest of your life. Or it's just a silly little tie. But things aren't always what they seem. Here's where we're going to go deficits. By the way, there's my friend Sonu and I. We were in New York City this summer. We were walking around, had some meetings, and there it was, the debt clock. Like, oh, look at that, the debt clock. So we took a picture in front of the debt clock. There we are in New York City. I think your family owes like $60,000 or something. We have deficits right now, right? We have a lot of deficits. That's just what it is. We're running about 6% of GDP. What in the world is this guy talking about? Just know that's like the most deficits we've run in non-wartime, non-recessionary environments ever. All right. Now, here's the thing about this. When you run high deficits as a percent of GDP, to keep this real simple, the economy usually does really well. Earnings actually do better. Now, you pay the piper maybe down the road because you kind of juice things too much. But for right now and into 2026, when we see deficits 6% of GDP, we think that's more of a positive, a net positive. And we'll use yings and yangs, but more of a net positive for your investments and honestly, probably for the economy. Israel's literally one of the strongest stock markets in the world the last couple of years, even though all the terrible stuff that's happening there with the war and everything, because Israel's really increased their deficits, spending as a percent of GDP. The U.S. back in when the market had the terrible tech bubble implosion in the early 2000s. I remember that. March 2003 is when the market officially bottomed. That is when the war in Iraq started. And that's not a coincidence. When the war in Iraq started, March 2003, the U.S. government started spending a lot of money to finance that war and all the stuff that was going to come with it. That's when deficits really got a lot larger as a percent of GDP. The market bottomed. The market sniffed out spending. We had a terrible economy for like 15 years after the Great Depression until what? Until World War II. Now, World War II is horrible. Not saying anything other than that. But there were some things that kickstarted our economy with all of the deficit spending and deficits that we were doing to get the economy going in World War II and honestly global economy in World War II. And then we had the benefits of the 50s and 60s as the economy continued to go after that. So we'll talk about tariffs for a minute. Well, not a shock. We had tariffs. I don't think it's much of a shock. President Trump literally ran on this. You can look it up. Tariff, the most beautiful word in the dictionary. Love him or hate him, he said that, and it shouldn't be a surprise that tariffs came out. Now, I could go all day on tariffs. The good news is we think the tariff war, for all intents and purposes, is over. Literally on Friday, after the bell means the market closed. Like thousands of goods tariffs were removed. Things like orange juice and bananas and stuff you use because we had some elections not that long ago. The honest truth, Republicans didn't do very well in the elections. It was very clear that people are concerned about certain things, prices being pretty much at the top of it. And now some of these tariffs are coming off, but there's something called the effective tariff rate. And I'm not going to get too in the weeds on this, but the effective tariff rate is all the price. What's a tariff? You buy a car from Germany, bring it over, you charge Germany a little bit of money. So the price is a little bit higher. That's what a tariff is, right? And believe me, a lot of companies tariff our stuff when it goes over there. So we're kind of, okay, well, we're going to put tariffs on you because it's coming here and make some money on it is the theory behind it. Now, what's happened, the effective tariff rate right now is like 12%. When President Trump held up that piece of paper on Liberation Day on April 2nd, everyone thought, 15% is pretty high. 17, 18 be really high. There's no way he's going to go over 20. He held up the piece of paper. The effective tariff rate, when everyone kind of squinted and looked at all the different countries, was like 26 or 27%. So much more than anybody ever expected. That's why the market crashed for a couple of days. All that crazy stuff happened. Then they kind of pulled back on the tariffs. President Trump literally wrote a book called Art of the Deal. If you go read Art of the Deal, the real simplistic version is he comes off like he's crazy in the beginning with this wild, demand, if you will. And then you barter from there and meet somewhere in the middle. At the start of this year, we thought tariffs, the effective tariff rate would probably be between 10 and 15%. It was up here. Now it's about 12 to 13%. So it's just kind of interesting how this stuff all shakes out. The tariff concerns with U.S. and China. China's going to buy our soybeans now, although I don't always trust them when they say that because they said that in 2018 too. But nonetheless, a lot of this is in the rearview mirror. Trade war is probably over. So we'll talk about politics. This is why I say don't throw anything at the speaker. Fortunately, we're pretty far away. I'll keep this right down the middle. I promise not to offend anyone. Or if I do offend you, I'll offend the other half in a second. Always ask this. People always say, who does the stock market do better under, Republicans or Democrats? Technically, market does better under Democratic leadership when you have a Democrat in the White House. Not by a lot, but that's just what history is. But you can see here, it's kind of going up, across the board. I mean, I just think about what's happened recently. 8 years. Oh, I can't stand President Obama. Amazing. Really, his first year was bad, but the next 7 were amazing. Don't like Trump 1.0. Stock market did really well. Don't like President Biden. First year, not so great. Last 3 years, really, really good under President Biden. Can't stand Trump. Well, the first 100 days are terrible. How's it done lately? Up literally the S&P's up 6 months in a row, and we're not that far away from all-time highs on the S&P 500. So again, we say it's not about red, not about blue. It's about green. Just kind of remember that when you see this. Now the flip side to it is if the stock market does better under Democrats, but just by a little bit when Democrats have the White House. What about Republicans? Well, when Republicans have both chambers of Congress, like they do right now, right? Not by a lot. I mean, the House is 5-seat majority, smallest in 140 years. But the stock market does better, a lot better, actually. You could argue you get more done when you have both chambers of Congress. Of course, you won't win the election. But if you control both chambers of Congress, sometimes you have more power. You can see here does better. But here's the key thing, everyone. And look at on the right. When you have a split Congress, stocks love it. The last 13 years, and what's a split Congress? The House is one thing, the Senate's the other. That's a split Congress, right? One party, split. Like our forefathers wanted it, not too much power one way or the other. We had a huge rally last year and President Trump won the election, right? I don't think it's because President Trump won the election. I think it's when that all went down, people were worried about a big blue wave. No one was talking about a red wave, honestly, but more of a big blue wave. And it's like, oh my goodness, then we're gonna have a big red wave when won all seven states, swing states, whatever. But then the House came out only a 5-seat majority for the Republicans. I think that right there was the reason we had such a huge rally or at least in November. Gave some back in December, but in November. Because when you have a 5-seat majority in the House, you know what happens? Not a lot. It's hard to push a lot through. The market loves gridlock. All right. So maybe the best Washington you could joke is one that can't get anything done. I mean, literally, stock market did pretty good in those 43 days we were shut down, and we reopened the market and everything, or reopen and the market goes down. Of course, I'm kind of joking, but the reality, and this is again just facts. Please don't shoot the messenger. The party that loses the election is the motivated party. They gain between 20 to 30 seats in the House during midterm elections. Midterm elections are next year. If the Republicans have a 5-seat majority, history would say, likely the Democrats gain at least 5 seats, 6 seats, whatever, or whatever. Actually, you need like 3 to flip it. But anyway, maybe gain 20 seats. I don't know. Let's just say that. Now, the Republicans have 53-seat majority in the Senate. And if you look at the Senate map, and this stuff's way above my pay grade, but the Republicans apparently have a little bit easier map. I don't know. That's what they'd say. The Republicans probably keep the Senate. Everybody, that would be a split Congress. The last 13 years at a split Congress, the stock market went higher. So that's a year from now. I get it, but those are just some concepts to think about as we move forward. But my friend Sam Stovall said it best: if the opposite of pro is con, then the opposite of progress must be Congress. There you go. All right. So that's Janet Yellen. Used to be in charge of the Fed, and she's in charge of Treasury, and now I think she works for PIMCO, because that's what everybody does when they become old and retire. Go work for PIMCO, make a bunch of money, and do some podcasts. But big fan of hers. Let me get a drink. 1 second here. And don't you? I like it. McAllister's. You guys have McAllister's up there? I love McAllister. It's a huge drink. I love going. Went there with my wife for lunch, and I've been drinking this iced tea like all day. It's huge iced tea. So anyway, that's my
We don't have
McAllister's.
it.
Oh, well, if you ever, yeah, I mean, food's fine, just a standard deli place, but a huge drink. So drink iced tea all day. Anyway, there's Janet Yellen, and there she is in front of Congress reading our Outlook 2023. So what happens is you get to be grilled by Congress, and they call it grilled. I don't know why. It's slap on a tariff, or grilled by Congress. And twice a year, when you're in charge of the Treasury, you get to go be grilled by Congress. And there she is in front of Congress reading our Outlook. I'm kidding. That was photoshopped. But nonetheless, it looks pretty good, doesn't it? So she was in front of Congress reading something. I said, this is like the day our mid-year Outlook came out in July of 23. I said, wouldn't it be cool if we like put that there? So marketing stuck it there. And I shared this, and media people, do a lot of media, my buddies and stuff, they reach out and say, oh my God, is she in front of Congress reading your Outlook? I said, no, but we're pretty good at Photoshop, aren't we? Anyway, so there's a lot of stuff that our team does. It sounds like, thank you, John, for sharing a lot of it. It sounds like Facts versus Feelings is probably the easiest way. Our weekly podcast, where literally everything we're talking about today, Sonu and I talk about every week. So wherever you get your favorite podcast, if you like some of the concepts we're talking about, Facts versus Feelings, be honored if you could sign up for that. So we'll do equities for a little bit. We've been talking about, yeah. So I'll finish in 10 minutes. I'll finish 10 minutes here. We got equities coming up, and then we can do some Q&A as long as you want. The average, there's a statistician, right? Put his head in a bucket of ice and his feet in the oven. They said, hey, how do you feel? He goes, you know what? On average, I feel pretty good. That's an old statistics joke. Only 4 times in history, everyone, have we seen an average return. Average return is between 8 and 10%. Okay, 8 to 10. That's what stocks do. 4 times. 4 times, that's it. 22 times stocks were up 20%. 21 times stocks were down. The odds of a 20% up year are better than a down year. I mean, think about it. That's just kind of wild, but it's really important as we're kind of ending this year, going into next year, thinking about 2026, to remember that bigger swings are normal. And that's just how the market's taught us that. There's lots of people in my role that'll come out and say, I bet we gain 10% next year. I don't know. Bet we don't. Because the odds are usually we don't. We usually have bigger swings one way or the other. And again, we came in with a 12 to 15% total view. Honestly, amongst friends, we're probably going to keep that for next year. We might gain between 12 and 15% on the S&P. So better than an average year next year is how we see it. Just remember, average isn't so average. What do we have here? Okay, so when you're up a lot going into the final 2 months, we're up more than 15% the month going into November on the year. And you can see here, November actually does much better. December does much better. And I think it's like 20 out of 21 times the final 2 months of the year are up when you are up at least 15% for the year going into those normally bullish in the year. Why is that? I think it's because a lot of people usually miss their benchmarks, like people in my world, right? They invest people's money, and everybody got freaked out in April and they sold, and they've been behind the 8 ball. So any volatility, any weakness is bought up. Now I want to be very clear. The S&P 500, everyone, just went 6 months, okay, closing within 3% of all-time high. That's like one of the longest things ever. We just had one of the strongest 6-month rallies in history. NASDAQ up 7 months in a row. S&P up like 30 or 40% the last 6 months. It's been an extremely strong run that we've seen on the S&P 500 for the stock market the last 6, 7 months or so. To have some volatility, a little bit of weakness, I'm not shocked by it. I think it's healthy. I think we're refreshing the fear. I think people are getting a little worried about what's going on out there. That's good, all right? Because if everybody's thinking alike, somebody isn't thinking. General Patton, I like to see this refreshing of fear. We're still optimistic. We're going to make new highs. Only 6 times in history, going back 75 years, has the stock market peaked in October. We peaked October 28th. Did we peak this year on October 28th? Is that it? I don't know. Going to say probably not. We're still pretty optimistic. We're going to gain some more. We're not that far away from an all-time high. I know it feels like it if you really pay attention to the market because what's going on in some of the high-flying sectors. But overall, the market's not that far away. We're optimistic we'll have some good news. And thinking about this is some stuff Sonu put together. Make sure I read it correctly here. Yeah, 68% of the time, if you don't have a recession, which again, that's our base case next year, no recession, the stock market's up double digits. It's like 70, I mean, round it for government, like 7 out of 10 times you're up double digits if you avoid a recession. And then scroll to the left. It's very rare to have a big down year if you don't have a recession. And that kind of makes sense, right? 2008, terrible year. That one stands out. 73, 74 stands out. 1990 is not all that great. Those are recession years, okay? If you have a recession, the economy slows down, earnings slow down, people lose jobs. Yes, the stock market's going to struggle. But if you don't have a recession, the odds of a down year or big down year are very slim, very, very slim, as we show here. But the odds of a pretty good, double-digit year, I think it's possible. I mean, I don't know if we're going to be up 20% this year on the S&P for the third year in a row. Going to take a good rally. Probably going to be up double digits, right? Only 3 times in history do we have a year that was down 15% for the year and then finished the year up 10% or more. This year could be number 4. It was, I think I'm going to remember here, 1982, 2009, and 2020. That, I call this a slingshot. That next year, those 3 previous times, was higher every time, up 19% on average, and every year was up double digits. I think that major refresh of fear we had in April after a big rally scared everybody. Now the slingshot is still in play, and there's a lot of other reasons for that, but that's where we are with it. Bull markets last longer than you think. I think, yeah, okay, we'll just do this one. This bull market just reached its 4th year. All right, 4th year because it's turned 3 years ago bottom, so we're in the 4th year of bull market. Check this out. The last 50 years, when a bull market got to this point, the average length of the bull market was 8 years. The shortest was 5. We had like an 11 and a 14 year. I'm not saying I'm going to go 11 or 14 years. What I am saying, it's like a cruise ship, right? Cruise ships are hard to slow down. They're really hard to turn around. They're hard to stop. Once bull markets get moving, they tend to keep moving. Yes, a 100-year pandemic will slow it down. Yes, there's certain things that can happen. But this is a concept we've talked about for a while now. And the 4th year bull market, we don't think if we get to do this next year, we don't think this bull market's going to be over. We think there's still some tricks up his sleeve. So I already talked about this, but volatility is the toll we pay to invest. Just remember, every year on average, sees a 3% dip 7 times. A 5% mild dip, 3 times a year. 10% peak to trough correction once a year. And a bear market every 3.5 years. Print this one off. Keep it. It's important. Going into next year, say to yourself, you know what? I'll bet stocks are down 15% at some point during the year. Because that happens. On average, since 1980, the peak to trough correction is 14.2%. You can do yourself a big favor by expecting normal volatility. That way, when it happens, it's not fun. It's uncomfortable. I do this for a living. We do this for a living. I get it. But to remind ourselves that this is normal. Most years have scary days. Most years have bad days, bad weeks, bad months. That's just how it works. If it went up every day, it wouldn't work. That's not how things work. But just remember some of these concepts as we go into next year. We have some scary days, scary bad things. I'll skip the earnings one. Earnings been really strong. I know we're getting kind of near the end. We call this a Carson quilt chart. A lot of stuff going on here. I just want you to look. These are sectors. I just want you to realize if the thing that you're loving, like say large cap tech the last 2 years, Wow, that's great, John. I should be all in large cap tech. Look how great it's done for 2 years. Or the flip side is, wow, this other, like Europe. Europe's done terrible for years. Started this year, nobody wanted to own Europe. I don't blame them. Europe's done terrible forever. Europe's really doing well. Tech obviously been struggling a little bit lately, although it had been doing well. I'm just saying, I call this the shiny object syndrome. Right? These are geeky things we use, like rebalancing portfolios and sticking with your plan, sticking with your process, not always chasing the shiny object. Just remember this when you see a certain group doing well or vice versa, doing poorly for a couple of years. So I don't want to own that group. They're terrible. Like in 2022, utilities were annihilated because interest rates went up and utilities don't do as well when interest rates go up. Well, now utilities have been on fire for a couple of years. Why? Because of AI, because of all the electricity we need to create for this. So utilities are soaring. So nobody wanted to touch utilities 3 years ago. I promise you that. And now it's like that's one of the strongest groups. So just kind of remember this when you're investing. This quilt chart's really, really important. But it is confusing. I came to that sign the other day. I had no idea what to do. I did turn left though. I did turn left. I don't know if that's the correct thing to do. Earnings have been strong. Earnings continue to justify this bull market. This is forward S&P 500 earnings. So we say volatility is a toll you pay to invest. We also say earnings drive long-term stock gains. Earnings still are really solid to us. Earnings are solid. Profit margins are solid. We call that the dual tailwinds to a bull market. Both of those are still solid. Been talking about these for 2.5 years now, and they're still solid. So these are reasons to think stocks will probably continue to go higher as corporate profits go up and profit margins stay solid. Now, I know one of the questions came in. I added this. Don't tell compliance. Whatever. It's our amongst friends. It's approved. But we hear all the time like the market's top heavy. Only 7 stocks going up. Only this. Only that. The top 10 stocks in the U.S. make up 40% of the stock market. Like those are Microsoft and Google and Meta and all that stuff. Apple. You've heard of all of them. 40%. The TV tells you that, whoa, that's top heavy. If it wobbles, the whole thing's going to fall apart. What we just updated literally before this call, I said, hey, let's update this chart because it was one of the questions we had. I think it's a great chart. I mean, you see it now. You've been looking at it probably. The U.S. is one of the least top-heavy countries. These are the largest 25 stock markets in the world, and how much their top 10 stocks are as a percent of their overall stock market. I mean, what is it? Japan and India are less than the U.S. And you can see the average is 67. We're about 39. I don't know. I mean, it is what it is. I remember when Apple hit $1 trillion back in 2017, and everybody back then said, "Oh my goodness, that's it. It's too big." These back then it was called FANG. Now we call them Mag 7. It's called FANG back then. Anyway, FANG is going to peak because Apple hit $1 trillion. Now Apple's at 2 or 3 trillion. Nvidia's at 4 trillion. I'm not, I don't know, but I know this much. These large companies are making a lot of money. Nvidia the last 3 years was up 1,500%. Their earnings are up 1,425%. Again, justifying, in our view, this move. Maybe they got a little frothy on the AI side of things. That's okay. You know what's done really well the last 2 weeks? Energy, healthcare, different names. That baton gets passed around. I mean, listen, we have we have large cap exposure. We have tech exposure. I'm sure most of you on this call have that. So when it goes down, it's not fun. But this is why we keep a diversified portfolio, why we look around the globe. We see opportunities around the globe. Don't go all in on one group just because it's hot. Because again, it's going to come back down. Just earlier this year, semiconductors had a 35% bear market from May to early April. I think people forget that because then they just came ripping right back. So just kind of remember that. I'm almost done. So my doctor said he need to start eating more fish. And I said, Doc, I don't like fish. He goes, it's okay. There's this new fish. I want you to eat it. There it is. So there's the fish I've been eating. If you all need to eat more fish, that's a wonderful fish. And hit me up later. I'll tell you where to find one of those. I know we're almost done. So how do we want to live our life? How do we want to live our life? We're done. Then we'll do Q&A. I think we're okay time-wise. Yeah, sorry. Went mine a little long, but I can do Q&A as long as you want here. So there's Tiger, right? Look at everybody. Everybody's watching Tiger through what? Their phone, right? One of the most famous people in the history of the world, or at least right now, one of the famous people right now, Tiger Woods. Everyone's watching him through their phone. Now, there's Tiger a long time ago. People weren't watching through their phone. They were watching Tiger. Now, someone made a comment to me, well, that's Masters. The Master, you can't even take your phone to the Masters, so maybe that's why. But, how do we want to live? And I'm just as guilty as the next person to a degree because I travel all the time. I usually get more work done on a flight just on my phone than I do on an average day. I mean, that's just luxury maybe I have, and maybe a lot of you are that way. but we do look at our phones a lot. We do this, we do that instead of like calling up our friend or doing things face to face. And I think as we head into next year, a little quick story. There's my mom, brother, dad. My brother called me the Friday before Memorial Day last year, so that would have been 24. Yeah, the Friday before in 24. And he's like, hey, he's called me 10,000 times. Whatever, talk about whatever we talk about, stupid brother stuff, stupid stuff. Probably just make each other laugh. And then he goes, I got some bad news. I'm like, oh yeah, what's that? Whatever. Baby brother, by the way, baby brother. He's like, I have cancer and it's really bad. Now, when you hear that, we've all, the truth is everyone's probably been on that phone call, one way or another. If you haven't, you're lucky. I'll just be honest, you're probably going to get that call someday, and it's not fun. Not fun at all, because I can tell you that. So for the next, I guess, 7 months, 6, 7 months, watch my baby brother suffer. Just struggle, the ups and downs, honestly, more downs than ups. Went to the Ohio State University. I know, sorry. He spent like 17 or 18 days in a row in this little room at Ohio State. He just was so sick. They're pumping him full of everything. Just miserable, just miserable. I remember spending the night with him, almost a year ago now, which is crazy. Early December, and his wife would spend the night. And I'd drive up from Springfield, Ohio, live in Cincinnati, drive up to Springfield, hang out with him. You just sit there. He couldn't really do anything. He couldn't talk that much, tubes and stuff, just what it is. We still just want to be there for him, So I'd take turns, not turns. My sister-in-law did a lot more than I did. I got a family, a wife and kids, but I'd go up as much as humanly possible with everything and my demanding job and everything to go see my brother. Anyway, spent the night with him one night, and it was just terrible. It was early December, and he groaned and moaned, and he just was it wasn't good. It's just terrible night for everybody, including, I mean, not for me, whatever, big deal. I didn't get to sleep, but my brother was just miserable. So what I'm getting at is he passed away in January of this year, all right, on January 10th. And my sister-in-law called me, and she's like, hey, hospice is there. And we knew this was coming. She's like, bad, hospice said it's happening. You need to get up here if you want to be here. Like, okay. So as an Ohio State fan, again, sorry, everybody, Ohio State was playing Texas that night. I go, and I preface this by saying, Aaron would think this was funny. I promise you. What I'm about to say, this is brother stuff. Brother, you got a brother, brother saying anything to each other. And the first thing I thought was, oh, Aaron, you're gonna make me miss the game. So anyway, so of course there's snow. You guys know snow. You've got tons of snow up there. So it's like it took me like 2.5 hours to get up to the hospital, knowing I'm going to see my baby brother die. I mean, that's just the truth of it, right? Thinking about that snow, want to watch the game because I'm a football fan. All the emotions that come with it. And I got there, and he passed away like at 5:01, 5:02, something like that. And I went in. It's pretty emotional. My sister-in-law and close cousin, myself were there, and we all knew it was happening, but until it happens, it's still rough. Kiss him and everything, give him a little kiss, and I whispered in his ear, "Thank you. Now I can go watch the game." I promise you, he'd think that was funny. So anyway, so I called my uncle. I said, "Listen, there's no way I'm going back to Cincinnati. Like, this is a mess. Like, I'm not going back." We did everything with him. So I go to my uncle's house. We get some beers, pizza, guy stuff, and okay, Aaron passed. Let's have fun and watch that game. And this might hurt a lot of the Michigan fans on here, but if you remember this game, it was 4th down. Texas had to score. It was like 4th and 11, 4th and goal. Texas had to score. All right. And Quinn Ewers is back, throws the ball. If he goes in the end zone, they tie the game, goes overtime. Who knows what happens? Jack Sawyer comes around the side, smashes into Quinn Ewers. The ball pops out. The ball hit the ground. If you ever played football or watched football, that ball doesn't go where it's supposed to. That's just the way the football goes. That ball hit the ground perfectly, popped up perfectly to Jack Sawyer. He took it back 86 yards to win the game right at the end against Texas, and they played Notre Dame in 2 weeks, won national championship. To this day, I say my baby brother was on that field, popped that ball up to Jack Sawyer. That's what I like to say. So where am I going with all this? A little long-winded. I know we're probably at the end. Sorry. Have some fun. If you're on this call, you've made money. If you're on this call, you've invested right, you've got real estate, you've got different things, maybe some gold, maybe some crypto, which has come back, and we can talk crypto in the Q&A if you want. But still, you probably made money, right? If you're a grandparent, do it. Take your kids, take your grandkids. If you got to do it, because you never know when that call is going to come. You never know what's going to happen. So from everyone at Carson, from myself, I wish everyone a happy, lucrative 2026. We'll call it 2026, heading in 2026. But without our health, none of this stuff matters. So just kind of some things to remember. There's kind of our bottom line. We'll kind of leave that. This is what we call a client-approved deck, simply meaning we can share this deck later. You can dive in a little bit more if you want. I might have of skipped one or two slides, but they're good stuff here. Additional disclosures to keep the lawyers happy. All right, John. Well, I probably went long, but I can answer some Q&A as long as we want. But thank you so much for having me. This was an honor. Thank you.
Yeah. Yeah, thanks, Ryan. And I guess first of all, I didn't know that story about your brother. I'm sorry to
I
hear
made it
that.
up.
That's
No,
the
I'm
first time
teasing.
I
My
heard
brother would
that.
also think that was funny. I promise. Yeah.
Yeah, I've
Yeah.
I've got a brother too, and I totally get what you're saying. But
Yeah, there's certain
it's
things you say to your brother that I'd be fired 10 times over, but they're brothers. That's how we talk to each other. Yeah.
brothers.
Yeah.
I get it, but nonetheless, I'm
Hmm.
sorry
Yeah.
for
Well,
your
thank you.
loss, and
Appreciate that.
that's
Thank you.
tough.
Yeah.
I've been there, but I
Yeah.
do appreciate what you said, and that is something we talk to everyone that we work with too. Is this
Great.
money is here to make your life better? So let's
Hmm.
just make your life better.
Yeah.
Let's make it stable and make it better. So I
Yeah.
agree with you wholeheartedly. But again, thank you for making market strategy talk entertaining. But more importantly, thank you for having your facts right all this time, taking the emotions out of it. I've listened to you for a long time now, every
Thank you.
week, and you've been right. You were actually right in the middle of this call as NVIDIA's earnings came out, and they were
Oh,
huge,
good.
very positive. And you had alluded to that's probably going that way, and sure
Yep.
enough.
Good.
The
Good.
market's probably going higher tomorrow, so you're continuing to be right. So
Good.
I appreciate that very much.
Mhm.
But if I can ask one question, then I'm going to have
Yeah.
Jason ask one, and the Haley, they've got the questions that people have asked, and we'll just do this for 10
Sure.
minutes and we'll
Sure.
be done here.
Sure. Absolutely.
But since you did bring it up, the AI bubble is the big question that everybody
Mhm.
has on their mind, and that's what's in the news all the time. How do you look at that?
Yeah. Well, Kyle, I hinted at some of it probably. I don't think we're in a late 2000 scenario. That's the thing people are worried about because you hear bubble in the late 90s. People might remember this. If you don't, go read the stories. There were companies that would slap .com on their name, have an IPO, and go up 300%. It was crazy, wacky times. And that's what scares us. But when we look, John, at what's happening right now, these companies are, I mean, perfect example what just happened NVIDIA. I'll dive in, but these companies are making a lot of money. Now there are some smaller companies that maybe don't make as much. Listen, I'm old enough to remember Amazon didn't make any money for like 15 years. Now it was probably by nature they just spent it and reinvested everything. So sometimes there's companies that don't, but big picture, these companies made a lot of money. Did they get a little too high in front of the skis? Yes, they probably did. The Mag 7, some of these names had spectacular gains off the April lows. Maybe they were just due. What we're hearing is, somebody Michael Burry, that name might ring a bell to some people. He's the guy from The Big Short. He's Steve Carell. You remember that movie, Steve Carell, The Big Short? He called, they say, the housing market collapse. I mean, he was 2 years early, but he did call it. He's been making some big bets against these companies. By the way, he has puts, which means that the leverage bet on prices going lower against Nvidia, which maybe if Nvidia is up right now, that's Michael Burry's not
Yep.
happy, but oh well, that's how it
Yep.
goes. So that's out there. That's what we're hearing. We just think it's justified. Now, I'll say this much. CarsonGroup.com/research. That's our blog. Sonu just wrote an incredible piece. Maybe you can share with your clients some of the questions we have on this AI thing, like literally 2 days ago, maybe. And he talked about riding the wave. Nobody knows when this is going to end. If this is like 1996, 1997, all right, the S&P like doubled after that. Now, yeah, there was eventually the music stopped, okay? But we're thinking about calling our outlook for next year riding the wave. If you think about that imagery, a lot of behind you, it's beautiful, but then sometimes waves are dangerous. If you fall off, it could be bad, right? So yeah, it's an outlook, so you got to have something kind of sexy. But riding the wave is real, and when some of the work Sonu's done and things, we think this is still the early innings. The honest truth, though, like the tech bubble, I mean, all those companies went down 90% or went out of business, right? Even like Amazon. Time Man of the Year in 99 was Jeff Bezos. Look at him. He's a youngster, look all funny looking. But that stock went down 86%. All right. There's just a lot that can happen. There's going to be winners and losers. Some of these might get a little too frothy and come back to earth, but the truth is earnings are solid. We do not think this is a bubble. And I think this refresh that we've had the last 3 weeks or so has been really nice to get some fear. And now we're getting the justification, probably by NVIDIA this evening, that things are still pretty solid. So long-winded way of saying not a bubble.
Great. Thanks, Ryan. Jason, do you want to uh, ask the first question?
Yeah. Um, hey Ryan, thanks for coming here this evening. But
Yeah.
I have a client that wrote in that said, I hear that they hear and read a lot about 2008, another correction coming. It's similar to what you kind of just
Mhm.
impacted on. But what are your thoughts and how do you prepare for it?
Yeah, well, great question there. I mean, the good news is a 2008 type of deal is like usually once a lifetime. So if you were around then, hopefully we don't have it again. We had 250% bear markets in the aughts, right? 2000 tech bubble burst and the market went up a little bit for 5 years, then crashed again. The aughts were the worst decade in history, right? So I think to just say blindly, let's prepare for a 50% haircut, I don't think that's really wise because a lot of people have kind of missed out hedging and getting worried about this big collapse. So I'll just say this. What we would say is when in doubt, diversify it out. Meaning, we came into this year not liking Europe all that much, but by about February, I'm sure football fans on here, Lou Holt said life is 90% how you respond to something, 10% what happens to you. We came into the year not liking Europe all that much, but earlier this year we started seeing some things on the fiscal side, different things taking place. We're Sony and myself like, ooh, wouldn't that be something if Europe starts to do well? We added Europe to a lot of the models we run. Thank God we did because Europe's done way better than the U.S. this year. And during the Liberation Day, Europe hung in there better than the U.S. did. So what I'm getting at, you don't have to be all in high flying stocks, right? The ones that were crushed, like what was crushed in the GFC was banks. I mean, I'm not minimizing it. Banks were down 80, 90%. Everything was lower, but keep a diversified portfolio. We have some bond exposure. We have some managed futures. We have a little bit of gold, and our real aggressive models have some Bitcoin. I know that opens up probably a can of worms for people, but you can have if you're aggressive, maybe 1% makes sense. So I'll just leave it there. But we have portfolios that are very, very well constructed, we think, to have different parts to it. So if there's a yin, there's a yang. And again, you can have some bond exposure, you can have some gold, you can have some certain things to help yourself from that. But I just don't think you can lose a lot of sleep worrying about when's the next 2008. I've been hearing about that, Jason, since, 2009. I know all of us have. Every year you hear there's certain people out there. Oh my goodness, Harry Dent. Look up him. He's always saying the same thing. How this crash is coming. The Rich Dad Poor Dad guy. I love the book, but listen, the guy's been saying the same thing 15 years, been dead wrong. I mean, so these certain people are out there doing that, trying to scare us. And a lot of times when you're being bearish like that, it feels like, come here, buddy. Put your arm around him. I'm going to help you. I'm going to tell you, this is all rigged. The government's rigged. It's all going to come crashing down. Versus someone like our shop who's been saying, listen, things aren't as bad as they're telling you. Fundamentals are solid. Market's going higher. People are like, I don't believe him. For some reason, they believe the bear because it's just kind of the way our brains work. But I think it's important to stay diversified, stay the course, know there's volatility coming. When's the next 50% bear market? I don't, I mean, hopefully not for a very, very long time. Want to be very clear. But again, if you're like last comment in the 2000s, stock market US did terribly. I mean, it was the worst decade since the Great Depression. Okay. It was pretty terrible. Gold was up a lot. Small caps are up a lot. Value was up a lot. Europe did really well. So again, you don't have to just be in the tech heavy area that was a big part of the market back then. You can diversify, and I'm sure that's things we talk about all the time. And I think that's one way to help you sleep at night. Maybe maybe not up like 100% because AI is up 100%, but when those stocks do what they've done the last couple of weeks, and that's led to a lot of uncomfortable nights for a lot of people that got a little too heavy on their skis in that previous leader. You can be in the boring stuff too. Nothing wrong with that. Help you sleep at night and reach your long-term goals.
Thank you, Ryan.
Yeah,
I think
thank you.
Haley will follow up with our next question.
Yeah, thanks again, Ryan. So you've mentioned a lot about the strengths in the equities and the continued optimism in the bull market. So shifting gears a little bit, we did have a question come in, and they were curious of what's driving gold to new highs.
Yeah, great question. So gold, it felt like was around $2,000 an ounce for a while. Now it's $4,000 an ounce. In 2022, when the war started, the U.S. and other countries put a lot of sanctions on Russia, and they froze assets and did. You can go look all this up. I mean, above my pay grade, but they did some things that then other countries looked at that and said, "Ooh, if that can happen to them, you know." Could have happened to me. So they started to buy gold. Central banks around the globe have been buying gold hand over fist for years now, specifically China, different areas. Even the US has a lot of gold, right? So central banks have been buying gold a lot. Now, the flip side, not flip side, the truth is people say, is gold like a disaster play? I don't think so. Again, give us, I guess what we say, give yourself some flowers. After the regional bank crisis in March of 2003, our shop, Carson Group, came out and said, we're going to add some gold to some of our tactical models, meaning like, a model that goes out a year. We added some gold. And I was on record back then saying, listen, we could be entering a period for years where stocks and gold go higher. That wasn't very popular because no one else was saying it. But you look at history, there have been periods for 5 or 6 years in a row where gold and stocks have gone higher. We're 3 years into this with gold and stocks going higher. So I think this makes sense what we're seeing. Now, gold is up like 50 or 60% for the year. As people probably know, gold was extremely stretched. We talk about rubber band being stretched. It was extremely stretched, like 4,500 or so. Now gold's around 4,000. We still like gold in a portfolio as a hedge. If you said what's going to be better next 10 years, I still think it's stocks. Next 5 years, still think it's stocks. But having a little bit of gold to us makes a little bit of sense to hedge your portfolio. Think about a 60-40 portfolio. And I get it. Everyone on this call has different investment, investment goals. Let's be very clear there. But 60-40 is kind of the tried and true. 60% stocks, 40% other stuff. Used to be 40% bonds for a while. But now in that 40% other stuff, we think it makes sense to really have other stuff, really other alternatives. There's lots of other alternatives you can do. But does have a little bit of gold, kind of makes sense still. And at the end of the day, it's central banks buying, and they are not slowing down. Trends take place. They last a lot longer than you think. Should this gold bull market end right now? I don't think it is. If it did, that'd be about 3 years. That'd be the shortest gold bull market in history. You got gold go back 200 years, right? These gold bull markets usually last about a decade. Doesn't mean every year is going to be up, but they can last a while. So to me, this cycle of higher gold prices is probably here to stay. Honestly, commodities in general, I know crude oil, what it's doing, but look around. Copper has been strong. Natty gas has been strong. Different commodities have been really strong. And so these cycles, I say if you drop it, hit your foot, it hurts. That might be something you want to own. For the next 3 to 5 years, I think you want to have a portfolio that has some stuff that if you drop it, hit your foot, it hurts. That makes sense to have in your portfolio. We've been seeing that in a big way. And I'll just say this much. Crude oil's been, kind of low. I think energy stocks have been thrown out with the bathwater, baby the bathwater. I think energy, we don't have much energy exposure. This is things we're thinking about in 2026. I wouldn't be shocked at all if energy stocks started to do a lot better, following some of the other commodity leadership that we're seeing globally. And one final thing, copper is like flirting with all-time highs. You don't see that when the economy is weak. You don't see copper strong when the global economy is slowing down. You see the global economy gobbling up copper because it's industrial metal. You need it for different things. And that's what we're seeing, right? So it's another clue to us that this volatility we're seeing now is just simply volatility after a 40% rally in 6 months. But the global economy is on firm footing. But yeah, central banks are buying up a lot, and we don't see it slowing down to answer that question.
Great, thank you.
I think we have time for one or two more, and then we'll probably
Perfect.
wrap it. Jason?
Yeah. So Ryan, one of the questions is that, obviously we've got a very interesting political environment right now, and part of it's for TV, as you said, and some of it's for other pieces of it. But if the Supreme Court rules against the Trump on tariffs,
Yeah.
what do you think that does to the market, or what kind of impact do you expect to see from that?
Boy, that's a good question. That's one we've kicked around a little bit. First things first, I don't believe we're supposed to get those results from the Supreme Court until like next year. Like I think it's sometime. So it's not like it's going to. Who knows? I mean, famous last words might happen tomorrow, but it's not supposed to be for a while. Now, the honest truth is, I think the market will like it. I think the market would like that because it's like less drama. Because what we've seen with tariffs is kind of like a dial, right? You can say, I'm going to add, I don't like this. I'm going to put tariffs on you. China, you did this, I'm going to put tariffs on you. So it's like this uncertainty that's out there. So I think if it's taken away, that dial's taken away, or you need to go to Congress for it. My God, it took us 43 days to get the government open. I mean, imagine adding tariffs to some random country. It's probably not going to happen. So I think that could be a potential positive this year. But let's be very clear. One of the surprising things, I think, to most people, President Trump did a bunch of tariffs the first time, Trump 1.0. President Biden literally left every single tariff the whole 4 years he was in, and he actually added a couple. So you do have to wonder, whatever happens to the next president, whatever party it is, will they, assuming that the Supreme Court doesn't do anything, which I don't think they will, honestly, but we'll see. We'll see. I could be wrong. Will the next party in power, who's getting, hundreds of billions of dollars in revenue from tariffs, want to throw that away? I don't know the answer to that. I don't know the answer, but I do know President Biden, most of us thought he would take those tariffs away, and he realized, okay, this is some real money I'm getting. Things are okay. I'm going to leave it on. So just some interesting questions, maybe something to think about down the road. But I think the market would like it because that takes away that dial that President Trump has, and that's just a little bit less uncertainty out there.
Thanks
Great
very
question.
much. Appreciate that.
Great question.
Haley, do we have one final question for
I
today?
think that was it. There was one, but it was already answered. It was just the thoughts on the tech bubble. So
Yeah. Okay.
Perfect.
Okay. Well, I guess with that, we can kind of wrap it up. And for those, that couldn't see this today, we are going to get this recording out so everybody can either watch it again or pass it on to whoever they want. And those that didn't get to see it will get to see it. But appreciate everybody's time. Anybody has any further questions for us or even for Ryan, reach out to us and we can get to Ryan. But thank you all for joining, and we'll see you soon.
Thanks,
Thanks, Ryan.
everybody. Appreciate it. Thank you.
All right.